Today's topic is about the power of frequent trading. In a video that I put out last time, number 60, I try to compare between the two basic methods of trading. One is frequent trading, the other is buy and hold. Let me try to repeat this very briefly. When you do buy and hold, you actually are doing buy and pray, because you pray that the price will go up eventually so that you can sell the stock and make some money. So this is a very vulnerable situation because your cash is tied up in the stock and you're subject to the mercy of the market totally. However, if you do the other method, which is frequent trading, you are in fact buying and playing at the same time rather than buy and pray. So this will be less vulnerable because your cash is not tied up. You will sell the stock whenever you can make a reasonable profit. The major point is that when you do frequent trading, you try to earn a small, reasonable amount of profit each time, but frequently. So they all add up in months and years. In this way, you always put yourself in a situation where you have some cash to buy and you have some stocks to sell on a daily basis. This is the best situation you can put yourself in. Remember, I told you that the power of the big guys, they have a lot of cash to buy and a lot of stocks to sell. So you are more or less like them. The only difference is that you have some cash to buy and some stocks to sell. Why you have to do frequent trading? Well, the important thing is that you take advantage of the frequent ups and downs of the market. And you don't have to tie up your cash entirely because you sell very often. That will release some cash for you. In that way, you can replenish your cash each time you sell. And if you have cash ready, you give yourself more chances to buy more stocks. And you have more chances to buy when the stock comes down temporarily. What are the prerequisites for frequent trading? Well, the first one, of course, is you gotta have enough cash to start with. This happens to everything besides frequent trading. If there's no cash, you cannot start anything. Secondly, you have to identify the stocks on the uptrend. If you happen to buy a stock on a downtrend, it doesn't work for you. Well, in any case, if you buy a stock on a downtrend, it doesn't work. And you have to identify stocks with a big up and down margin. And you don't have to spend that much time to do the frequent trading. I advise you only need to spend 1 hour or so every day, and that's enough. You don't have to babysit your stocks. Now let me give you some examples of the stocks that you should look at. And these examples are selected based on three things. First of all, they have gone through a bottom. We have seen the bottom already. So it's very safe. That means they are on the uptrend. And they are slowly moving up. You can see that through the months. And also they have large variation margins. And I try to separate them into different industries: chips, AMD, and CY. These are the prices that I got a couple of days ago. If you look at them today, the prices are not the same. Other high-tech, MOT, AMAT. In the materials industry, Alcoa, General Rubber and Tires. Auto industry, Ford. Conglomerate, big companies, GE. Solar industry, YGE and STP. If you have time, you should take a look at some of these companies. Now, let me give you some figures to illustrate that frequent trading is a better method. Suppose you have an original capital of $10,000 and the stock that you selected is ABC stock, about $5 a share. And if you use the first method, which is buy and hold, you can buy about 2,000 shares all at once, at one time. And then you sit there with your money tied down, you pray and pray and pray for the stock to rise, and your prayer is answered. The price goes from $5 to $10 in a year. You wait for a year and you make $10,000. Okay? Now we come to the frequent trade. In frequent trade, you don't buy the stocks all at once with all your money. You just try to buy in batches. Suppose you buy 400 shares each time. That means you can buy about 5 batches with $10,000. Now ABC, after you have done some research, you find that it moves up and down usually with a margin of about 30 cents each time for a up and down cycle. Now, you also notice that there are hundreds of such cycles over the year. Suppose you only catch 1 up-down cycle first, okay? If you can catch 1 of them, you make 30 cents per share and you have 400 shares in a batch. That means you make 120 for each batch each time. And further, suppose that you can only catch 30 of these cycles because there are hundreds of them over the year. Well, if you can make $120 each time, you catch 30 of them, so 30 times, you can make $3,600 in a year. Now, remember, because you don't buy the stocks all at once, you can afford to buy 5 batches with your capital. And these 5 batches can be spread over either the same stock or different stocks. So you avail yourself many more chances of buying stocks at different prices. And your profit is, because over the year you make $3,600 for 1 batch, and you can do 5 batches. And the total profit will be $18,000. And this amount beats the buy and hold. Remember, we talked about buy and hold just now, and for buy and hold, you only make about $10,000.